Hello, ladies and gentlemen. Feel free to take a seat. I hope you're having a fantastic day so far. Our next session will deep dive into how copy trading and social trading are becoming a mainstay across key markets, acting as a conduit for scores of new investors to find success in the financial world. Let's welcome our moderator, Υannis and I, partner and option strategist at Traders Magazine, to introduce the piano. Υannis.
Thank you very much. Right, well, thank you very much for being all today. I know this is a wicked time slot when nobody shows up, so thank you. Tajinder, Salim, Mike, thank you very much for being with us today. So it's copy trading, and I think quite a few Gen Z generation and newbies are actually going into this marketplace. I'd like to understand the different types of a trader a social system is really about. And Salim, maybe we can start with you. So what is the target retail client as someone, who starts with that?
Thank you, Yanni. So our firm, I'm responsible for the CFD business of Bucks in the UK, and in Europe we run an FCA license and a SISEC license. In terms of the target, our segment is really the beginner CFD trader. And the background of our app is originally a stock trading app that we tried to build in 2014 and then defaulted to building a CFD trading app. So the way we run the product, it's a super simple interface that is app only, extremely simple. So there's no complex charts, watch list, things like that. There's whatever is hot in the market on one hand, and then you asked about social. That's the way we phase in those beginners. So there's a reasonably warm landing that is offered by the firm, but also by the trading community. So inside the app, you have channels that are run by external channel owners that talk about specific products, specific markets, specific trading strategies, or what they think earnings will do, announcements will do. And then guide a bit those newbies. The newbies are able to ask questions, which also helps us a bit of take the pressure off the customer service department. The other element of our social implementation is a battle feature where basically you and I could basically saying, okay, who's the best trader of ours? This is my historical track record, etc. Let's just agree we start Monday morning, we finish on Friday night, and see who is really on in live, basically the best trader in the channel.
Well, we'll get to this performance thing because I'm really interested in finding out how a black box can be avoided. But before that, Mike, what are the different types of trader according to Pelican? Because you come from a different.
Good question. I mean, we provide a white label solution for brokers. And what we find is that the brokers obviously use our social trading technology, and there's two types of specific user they go after. One is the trader that doesn't know what to do. So they've won the account, they've credited their account, but they want the volume. So they want someone there that's actually going to start to trade, and that's obviously when the broker gets excited because they're seeing the transactions go through. A copy trading platform, by its nature, lends itself to someone mirroring the activity of someone that does know what they're doing, in theory. So that's one of the key types of target audiences. Someone that is interested, they've probably seen something on social media and they've gone to a copy trading solution to try and mirror what they might have seen on social media. It could be someone with a Ferrari or a glass of champagne, which is quite dangerous. But essentially that's one key dynamic. The other part that we see that brokers really target is the IBs, because they incentivize the IBs to go, hey, if you come onto our social system, you bring all your followers with you, we'll put you at in one of our exclusive sections within the app, and therefore you'll be promoted amongst our wider audience. And that becomes a really powerful tool for the brokers because they can start to hero specific IBs, and that forms kind of a drag for all their copies coming on board. So those are the two target audiences. Generally, the person that knows what they're doing, that's got some trading knowledge, can be curious, but the brokers don't tend to go after them, certainly with our technology, and they're kind of left alone because they kind of know what they're doing. But yeah, it's those specific silos. Someone who doesn't know what they're trading and an IB, and it's a hugely impressive tool if used in the right way, any social system, to really kind of manage those types of user.
Okay. Tajinder, you come from Zulu Trade, which company pretty much dominating, so to speak, the sector, and I want to go into the nitty-gritty asking you about if the categorization, like in terms of performance, market, and maybe people following, is this the right way to choose, or are there any other parameters that you think more important?
What was the third one? So you said categorization in terms of?
By market, by performance, and the number of followers. So how many people copy one trader?
If the categorization is to identify who's a better trader, or what is the type of the trader, then that is not the right way to categorize it. So I come from a buy-side background where we have managed funds for hedge funds and whatnot, like the prop shops and things like that. We don't talk about Sharpe ratios, we don't talk about Sortino ratios, we don't talk about downward deviations in copy trading because it's too complicated, right? But because technology is so easy these days, we can run these things in the background and not categorize based on what people see, but categorize based on what actually matters. Because if Sharpe ratio becomes, let's say for example, it's one of the things, if Sharpe ratio is something you tell a retail guy who would not understand it, but if you use Sharpe ratio to evaluate the performance of a trader, it will basically not look at how much return he's made in the last 6 months, but look at the volatility of the return while he was making that return as opposed to the market in which he was trading. So there are much more ways to categorize people in a more, I would say, in a more sophisticated way than just looking at the returns and the followers and the views and the likes, essentially.
So what are the metrics that you probably want to apply?
At Zulu, we have been looking at a lot of metrics like Sharpe ratios, Sortino ratios, stability ratios, tons of them.
But we don't show these to the clients, the end clients.
No, because they would get confused. They would not know what are you talking about, and then they would run to someone else, essentially. Right.
Okay.
But there are even sophisticated portfolio managers who have been coming to us, and they want to look at the traders and the trader return profiles, so they can run these statistics themselves and package it up as basically a wealth management product.
Okay.
And just given the size of Zulu and the data that we have about our followers and our leaders, it becomes immense, wealth of data to find and categorize people.
All right. And Salim, do you think this is the correct way to go about? Like give a ready-made package easy to digest to the end clients?
So I'll answer in two ways. One, I'm a former private banker that did a lot of strategy analysis and mixing. This is 25 years ago. But still, we were dealing with managed futures as an overlay to traditional equities, bond portfolios, etc. So I think obviously in the private banking world, the clients are able to read a rather complex pitch, which certainly in retail space they might not be. I still think the user is responsible for his own experience and his own performance at the end of the day. So I'm always challenging whoever asked me, saying, hey, should I go with strategy A or B or C? I'm saying dig really deep and look into what's the AUM. I think these are things I would look at. What's the AUM of the strategy? What is the consistency of the returns of the manager in different periods? And does the strategy skew towards specific trades? So again, to just talk it in a more primitive way, is it a mean reversion or a trend following strategy, and how do you best mix these?
But do you expect end investors to do these analysis themselves, or do you read them like ready-made food?
I think it's obviously a JV of the provider, but also I think the investor needs to know what he's signing up. So let's just take the last 18 months of pretty basic stock market or index returns. Obviously there was a ton of volatility. If you're looking at equity strategies, momentum, buying all kinds of hyped up techs worked really well up until, call it November to April of this year. Yeah. Whereas if you're trying to make money with a long strategy in an environment like this, you will fail. So it's about the blend. And maybe that's the way I'm looking at it, to saying, okay, how do you explain risk and return? You mentioned all the ratios, kurtosis, etc. But I'm saying the mix of different strategies is what matters at the end of the day. And I feel too much in retail, it's the YouTube ad that says, I made so-and-so, I made 50% by following ABC, who drives a Ferrari in Dubai. So I guess it's everybody's responsibility, also the provider's responsibility, to saying, look, you don't have to gear up 100 times, right? If you want to trade aggressive assets, know that you can lose quite a lot of money. If you look at the US, where things are a lot more regulated with the CTAs, the average leverage is 5 to 10 times. And obviously, as a brokerage industry executive, I get pitches from lots of IBs that say, hey, can we go, can we do something, can we manage your money? And I'm saying, okay, what's the leverage you're using? Oh, 100 to 200 times. So I know the returns will not be consistent, because it's like driving a car at 180 kilometers per hour through the town center, and you know that at some point you will crash.
Eventually you will crash.
Yeah.
So, Mike, it looks like, we might be getting the crystal ball here by achieving diversification among different copy strategies, right? So, Mike, would you agree that, like, it sounds too good to be true, actually? So I just get on board, I know nothing, choose about a few traders who are stars in what they're doing, but at the end of the day, they will come, at a time where they can lose money too.
Yeah, I mean, essentially, a copy trader by their nature is a bit lazy. They want the decisions made for them by somebody else, and that's kind of why they're there, and you've got to respect that and understand that. So they will look at the metrics on the system and go, okay, well, who's got the most copiers? And they'll pile in there. They'll probably ignore everything else. And you can show them loads of stats. It's either the number of copiers or their mate told them that they made money doing something else. You can't really fight that. So you find that people come into a copy trading system, they either go to the most copied, or they go and do something that their mate told them they're making loads of money on. And they'll do that and experiment with that. And if that goes wrong and they've still got money left, that's when they'll start to actually look, okay, let's have a look at some of these metrics and see, is anyone out there any good? And that's when actually they can have a bit of a longer term and better relationship with the system itself. Some of them do diversify, so they will copy multiple strategies. But the problem you've got is, by their very nature, if you've got someone copying 3 or 4 strategies, you need just more margin. And copy traders don't have lots of money. Their deposit sizes average between like 750 to 5,000. That's about average. So if you're copying 3 strategies, especially those one who run lots of trades concurrently, you're going to run out of margins and you're going to miss trades. So yes, you'd like them to diversify and experiment, but they don't tend to have enough road really to allow them to do it. And you just hope they're quite sensible. Certainly when we initially applied to the FCA many, many moons ago for our license, the FCA said, look, if you're going to get these guys into these mirror trade positions, you've got to let them get themselves out of these positions. And so, like most sensible copy trading platforms will have the ability that if someone is copying someone, it's all going wrong, that they can start to close their trades off or adjust some stops or whatever it might be. And it was a sensible rule that the FCA introduced, and it's been copied throughout regulators worldwide. But yeah, essentially, a lot of people just blow up too quickly to really get any further, and that's just a shame. They do get lured in by that Ferrari over and above a statistic, which is difficult to beat.
Okay. Tajinder, let me insist a little bit on that. So do you think that, exactly this copy trading is really increasing stickiness or retention for the client, or it's just buying like last month's hot strategy and, things go down the drain?
I think copy trading has recently become even more famous because of the eToros of the world, let's say, for example.
Yeah.
But when we really look at copy trading, we are looking at a leverage product that is going to have, a net zero leverage product. And if copy trading is mostly just working on Forex and CFD, it's not going to make people too much money. It's more gamification. It's really, if the copy trading is built on diversification across the scopes of instruments, stocks, futures, bonds, things so on and so forth, where there's less leverage, more non-net zero product. So if you're trading a future, it's a mathematical reality, it's a net zero product. If you're trading a stock, it's not a net zero product. So if you're buying future, I sell it, one of us will lose money.
You mean zero-sum game, yeah.
Zero-sum game, exactly. So if you just have copy trading on zero-sum game instruments with, really no diversification outside of zero-sum, it's just a gamification.
Okay. And so the sound strategy is, we all agree, a diversification between all profiles, right? But can the social community aspect of the platforms help these users achieve better and stick? Because at the end of the day, we all want them to learn about trading and achieve their goal. And, you guys with the companies, you help them achieve it better. And then along the road, everybody makes money. Salim?
Yeah, so we see that the early churn in the client relationship is the highest. So in the first week is where we see the largest drop-off. So the social element allows the community basically to help those beginners to saying, okay, don't overtrade, don't use too high leverage, maybe ask questions, do some research before you take the
I'm
plunge.
sorry to interrupt. I was going to say, they can tweak the system and they can say, oh, this guy is fantastic. Can I just like jump on 200 times leverage, right?
Yeah.
They can do that, but
Yeah.
they shouldn't do that. So who has the, the discipline to actually follow what the guy does?
Yeah, so I think for us the app is built in a way that it does not encourage leverage. So you can trade CFDs without leverage. Now clients choose to gear up.
It's not a
right?
CFD
So
then, is it?
It's small deposits, as we all say. Clients choose to gear up because obviously the lights are flashing. There's lots of colors. It's exciting. We get that, but we don't incentivize max leverage and saying, wow, if you gear up so much, you'll make X. So again, we are coming at the CFD product from the equity investing, in that we originally tried to build a stock trading app on a backbone of a CFD broker. And that's still the philosophy of the app.
Tajinta, you wanted to add something?
The
yes.
point that you mentioned is very good. If you've noticed that people, drop off within the first 1 week, and if you can educate the people, your clients in that first 1 week, the longevity of the client is definitely going to be much more, and he's going to be there,
But people are like, it's psychology, basically, especially for newbies, right? They don't know the drawdowns, they don't know basically meanings, and it's okay. We didn't know either when we started 30 years ago more. But is also the other risk, the adverse selection risk from the guy trading who wants to achieve alpha for his business to attract more followers. How am I sure as a client that this guy will not cross the limits in search of a greater alpha? How is the monitoring on behalf of the company really working?
So at Zulu, we have a lot of different features. Like we create these, guards where we can look at if a specific leader is trading, let's say 10 trades on an average, but now he's opened up 15 trades, his behavior is changing. If on an average he loses, 20 pips on a trade, but he's lost 30, his behavior is changing. So we've created something called Zulu Guard. It's something that basically alerts a follower as soon as we see the behavior of the leader changing. Okay. And that's typically the first sign where you see the leverage will start increasing, he'll start going in and out more, he'll start losing more per trade. Those are some things we can do, but we cannot handhold someone to say, don't take any more risk. It's adrenaline rush in some people, they slowly learn, we all learn. We learn by losing money to some extent, but we should not lose too much so we don't go back to the market again.
Okay, and Mike, do you agree with that? Like we need this set up to ensure everyone is happy over the long term?
Yeah, it's sort of a strange one, isn't it? Because our client directly are the brokers. Brokers operate two types of model, the A book and the B book. Historically they made more money out of the B book. So in fact, they think it's in their interest that people actually blow up and they take all their money if they B booked everyone. You've got a bit of a contradiction here because you've got a social system which is trying to raise the standard of traders in line with the best, and then you've got a broker who likes to B book, who likes people to lose. So they're kind of put in a bit of a weird spot, as are we, because we're obviously the supplier of the technology. But when that client does blow up in the first week, it actually doesn't serve the broker well, it doesn't serve the client well, and it doesn't serve the social system well either. If you've got a good platform and that person does trade well, sensibly, they, by their very nature, start to invite people. They start to deposit more, they start to trade in higher volumes, and actually that offsets any bigger wins that broker would have made on the B book. And it's taken quite a long time for brokers to realise that actually it's actually having someone trade well ultimately has far wider reaching benefits than them blowing up and taking all the money and putting it on the B book. So you don't want them to go in and have an absolute nightmare in day one.
Okay, the question for all of you, I think, would be like, if you deem important for brokers and trading providers to provide a gamified solution for the end users, and maybe Salim, you want to go first.
Sure. The question was, if we
if you think trading providers and brokers can provide a gamified experience
so again,
to end
we are
users.
catering to the beginners. So I think the more interaction there is with the app, the funkier it is. We have some kind of comic speech bubbles. If you do a positive trade, we encourage you. So we are aggressively differentiating to the standard come and trade on a Bloomberg-like system and you'll be successful. We are saying, look, there is a community element. There also has to be a fun element, and I think that's where gamification comes in. And we see that in the surveys of customers we do, when we survey them, people that have been with us for 5 years or more, they love the community aspect and they love the fun element of interacting with us as a firm and with the platform as well. So the tone of voice is very different. So there's no polite you, vous, or whatever z in the European languages. It's all a first name, which is quite different to other, call it more conservative financial services providers, and that's how we interact, and that ensures the stickiness.
Yeah.
I have a mixed view on gamification, because gamification, so it has the pros and cons. The pro is that it educates a person, it creates a community. I go to the same club from last 10 years because I know everyone over there. I know where to buy my beer from. I know who to have a chat with. And that's what happens when you build community. But also at the same time, gamification encourages more volume and more transaction per person in a given time period, which we know mathematically and statistically is against the client. So finding the right balance where the education stops and the community building stops and the speculation and over engagement starts, it's a very hard and a very thin line that you know when not to cross. So it has pros and cons. I just think that over gamification is going to be negative both for the industry and for the customers in the long term. But some of it helps.
You share with that, Mike?
Yeah, so I wanted to ask a question, because certainly we've dabbled with gamification. We have, obviously you look on the stats table on a profile and you can see the users, trading statistics, but we have something called badges. They get rewarded badges, depending on combinations of different trades they put on. It's kind of to keep their momentum going, even when they're not doing very well in it. But we sort of sat there and we haven't pushed it any further. And I just wanted to do this question really for Selim and Bucks, whether, because it's got the gamified feel, whether that puts a cap on getting the really big traders on, like the whales, although it still only appeals to a certain audience and you can't ever push just because of the feel. Is that the case, or is that?
I think 100% in that we have two platforms, so anybody that kind of progresses through the ecosystem and says, look, this is too basic for me, this is too childish, it's probably a bit too much. We're saying, look, here is your traditional platform. Before you go to ABC broker, we have a traditional platform as well, but obviously the USP of the firm is based on the fun app that is nice, easy to start trading with, compared to having to download all kinds of charts, lists, and figuring out how moving indicators and moving averages, etc. work. So we do have some large clients that stay on Bucks X. I think it has more to do with pricing for certain instruments where we might be a bit cheaper than the rest given the pricing model. But most of the big hitters then migrate to Bucks Markets, which is the advanced platform. But we do have clients that have been trading on Bucks X since 2014 when we opened.
That's impressive, so many years together with you. So my question was actually, in the CFD and foreign exchange environment, we've all got used to receiving a lot of education, right? So trying to teach people how to do it, diversification, risk management, and all that. And there comes copy trading, just crossing a line between all of that and telling, listen, you just follow this chap, you make money, you go home. It's money that you want to make at the end of the day. But no, I want to learn, because this guy tomorrow might fall apart. I will have learned something from him. By copy trading, he learns nothing. He's just seeing green, red, right? So my question to Zinder and to the rest of the panel is, this culture of educating people, is copy trading really negates all this effort or complements?
It depends upon the platform. So for example, at Zulu Trade, we have a social platform built within Zulu Trade platform. So you're not just coming here and say, copy this and you'll start making what he made and just show him a simulation of last 1 year to entice him.
He exchanges his ideas.
He exchanges ideas, he talks to people, people talk to people, you can see what they're talking about, you can get a sense of, whether it's just the numbers or it's the attitude of the person as well. He answers questions, you learn.
But does that get technical as well? So listen, guys, it's risk-reward ratio 1:4. I entered this. It's a 20% margin. Complicated stuff if you haven't taught somebody.
They do. I believe what happens is that's why you see a lot of Telegram, these Telegram groups by this trading education, ones. It just depends. I don't think everyone gets into it. I think people who are really interested would get into it. But then at the end of the day, if you are following copy trading on just CFD, and Forex market, and you don't have time for it, you rather not be doing it, you know.
Mike, what do you think?
I don't think one cannibalizes the other, actually. I think that the people that go onto a copy trading platform are never going to teach themselves how to trade. They want a really simple journey to mirror activity that they think will get them rich faster than they would by their daily job. So, you know, thinking that it's going to diminish people out there trying to learn how to trade. I just don't think the people that want to learn how to trade are taking their own proprietary decisions and they're cracking on. But the audience that teach themselves is very, very small. The audience that want to copy someone who's really good, in theory, is massive. So it's I think what one can look at is risk management. So if you can try and in any way, shape or form try and teach them how to sort of diminish the possibility of them blowing up by copying the wrong person, that's what one should try and head for. But these people are never really going to go and get out a chart and start sort of hacking through their some sort of data. They just by their nature they've seen something, they're excited by it, and they want to just copy it.
And Salim?
I think there's room for both in the kind of the global asset allocation of the individual investor. So there's got to be room to saying, fine, I will dip in to copy trading, look at multiple strategies, and try and dissect and or reverse engineer what those traders are doing, especially on the risk management front. I think there's a lot of learning versus letting losses run, pile up big time, versus a more disciplined strategy that comes in and out of transaction in a more measured way. But then also using the trying to dissect what the trader does, when the entry points are, size of position sizing, scaling in, scaling out, to then build up your own trading strategy. But again, I'm looking at whatever portfolios of 50,000 or more, which then warrant a more sizable investment of time into learning.
Tajin, the Zulu Trade is a big broker. They've been many years in the market, and obviously this is a lucrative business, the copy trading. So I was just wondering how a broker like yourselves and for the other panelists is ensuring that there are no legal borders and lines being crossed in the copy trading, is it?
First of all, Zulu is not a broker.
Okay, I thought that when you smiled.
And that's, that's I think one of the, I love the creativity that the industry is doing, in all honesty. Finvacia, got into, Europe a few years ago, and we are, in that respect, new into the market, but I see amazing creativity. But I still feel the beauty of Zulu by being broker neutral and telling the client that I have zero conflict of interest with you, and that's what we're trying to do at Zulu. Identify and find how we can minimize. We want to build community. We want people to learn, stay there, but also minimize their losses. So we are not, not that brokers who are copy trading are, making profits from it, but they might make in some brokers, some cases, but in Zulu that will never happen.
So you don't channel the clients to a specific broker. It's down to them to choose.
It's the client. He can technically on Zulu, a client can open the account and connect any broker account as long as the broker supports MT4, MT5, ActTrader, Xopen Hub. Any of those platforms, you come to Zulu, put in your username and password, you're done.
But if I want to trade spot shares of other products other than margin products, is it possible?
Sorry, come again?
If someone trades shares, for example, spot equity.
We don't have shares. So we do have shares right now in Zulu. We are not integrated with stock brokers, physical delivery based, but that's something which is in the roadmap for this year. So we are going to go multi-assets. We are going to go into stocks, bonds, futures, things like that, because we want it to be available across a very wide spectrum of people where they can actually diversify across scopes and strategies and type of investment. I'm talking to portfolio managers who are talking about multi-million-dollar portfolios. They want to see that they can actually have stable returns, not just following someone who's maybe sitting in a room in some cave and trying to, do some grid strategy, do some strategy that'll make money for 6 months and then disappears. So, that's where.
Fair enough. Mike, what do you think about crossing these borders for the sake of popularity?
Yeah, I think actually the three of us actually on this panel are probably one of the three only solutions that want or do have European or UK licenses. So most of us three are all pretty law-abiding. I think what one's just got to be careful with is how it's about solicitation. So that's the key part. Are you promoting into a jurisdiction which no one has a license for? The problem you've got and the danger you've got is social media. So you'll have someone who will be promoting on Instagram into the World Wide Web, that they're doing amazingly well, and you can get a Ferrari if you copy them, and that then pulls people back into a system, and that's completely. I mean, that's very difficult for the regulators or for anyone to be able to control, and they're panicking right now. Certainly in the UK regulators have a big thing about these unregulated entities that are going out there and telling you can get rich really quickly. That's the danger. So if you start partnering with these types of people, then and they promise things to a new user that definitely aren't achievable or haven't been achieved, you're going to get complaints, and that's what the regulators don't like. So you've got to be really careful. The issue with that is that these social influences are so powerful now. If you get a nod or a wink or a gesture from one of them towards a direction, you will literally pick up thousands of accounts within seconds. More powerful than I've seen it, and it's super cheap. Well, it depends on how much you pay them, but so at one point they're very, very powerful. The other point is it's really, really dangerous business to actually accept, but it's hugely lucrative. And I think that's a bit of an unknown sort of world that we're now entering into, and definitely the regulators have no idea how to deal with it. They've tried to outlaw it, but the problem is if you have a broker with regulation in the UK and also somewhere in the Seychelles, they can always claim that they've onboarded them in the Seychelles, so there's no issue there, and it's so difficult to track down. But that is definitely, and I think as social trading partners, we've just got to be sensible with people that are pushing traffic with unattainable achievements, and that's really dangerous.
Also, I think doing a policing on the community that we have to make sure that people aren't really sort of abusing the ability to attract certain people for a short term and make money. That policing is extremely important. Just like it would have on a forum, it should happen on a social trading platform as well.
Mm-hmm. And Salim?
Yeah, so I echo we like innovation 100%, and also echo the police is going around. I think maybe just to add to this, we as providers also need to look into the conflict of interest, right? So if the IB comes to the firm and says, oh, I have this great client book and I'm a great trader, and then we say, oh, this is me going back 10 years saying, okay, can I please see a track record? Well, I don't have one. It's the end of the discussion. So I understand we've moved on and we built lots of fail-safes and filters and things like that. But I think we need to look into, okay, what are the incentives for the trader or the portfolio manager or however we call him, right? So if he's heavily incentivized by trading commission or worse, client losses, it becomes a complex model to administer, and lots of firms, including us, wouldn't want to go there. So if you take it back to the asset management world or hedge fund world, there is no incentive by transaction or by commission as such. The asset manager or the hedge fund manager or portfolio manager would look at the cheapest / best possible execution and take his cut from a management fee and a P&L share. So I've always struggled with you get this per lot and you get that per lot, and it sounds great, but then I'm thinking, okay, what is the end client really signing up for? So I always encourage these portfolio managers to go back and say, look, you need to have a bunch of great strategies that are well mixed together, and then go out and market, but be on the side of the client in terms of how you are incentivized.
So we've been talking a lot about retail client needs, right? And I guess the overwhelming majority of people who come and trade based on copy trading are actually retail traders, right? In the classical way, the classical meaning, also with a little bit or a lot of money, I don't care. But doesn't it make sense for actually managers, people with a lot of money to come and as a diversified structure to give some money to a copy trading strategy from you guys? Because if I manage like 100 million and assign 5 to you, is that you do different things than I do. So it's also good. Do you have this type of clients?
There are people, who are very interested in doing that. I'll tell you a small story. So back in, I think, 2006, 2007, I was at that time I used to do capital allocation for a family office, across different hedge fund managers. And I was having discussion with one of the hedge fund managers over there who was building up a strategy where he would have, something very similar to social trading. That was the first time I got introduced to this whole concept of it. Now, when I look at, let's say, for example, the social trading that's, that we see these days, including Zulu Trade, we either have to have, registered portfolio managers who know what they're doing and they will lose their license if they're doing something wrong, and give the right kind of message to the institutional investors who have tens of private bankers out there telling them, we'll do it for you. So if we want them to take benefit of social trading, which basically in a sense means bring the cumulative knowledge together to make the right decision, and we see it happens like that. In that respect, we will have to have the leaders who also have the credibility to say that I'm coming here and I have credibility, that I'm not just sitting here showing off my Ferrari, like Salim said, and just bringing people in to follow me. So it has to be from both sides. Investors are looking at it and they've been looking at it forever. I think we as platform also have to evolve to cater to those investors.
I'm beginning to think that we mentioned more times the word Ferrari than trading, so I kind of like it. Mike, what do you think? Does it make sense for these big guys to get involved?
Yeah, I think that what's really happened, Zulu, as far as when we started out many moons ago, Zulu were kind of out there on their own, and then we sort of put our license in, then eToro followed, and then eToro have done incredibly well, as of Zulu and Bucks as well. But what's happened is probably at the very beginning, the big brokers that we were in talk to, because we were London-based with CMC, City Index, IG, they thought this was a spivvy space with, it's not much traction, they didn't really care much about it. Fast forward to 2 years ago, and then the value of eToro has gone. It's now 3 times the size of IG, and they've all been sort of caught napping really, because they haven't taken this space seriously. And what we're seeing now is with the institutions as well, they're starting to take it seriously, because the number of users using social systems creates a large groundswell of AUM. Then there's that AUM obviously is money for them. So we were talking to a private equity house recently who wanted us to start to post. Put fidelity funds up there, so actually people could start to mirror the activity of these large institutions. Now, that may be a long way off, and they were interested in us putting those conversations forward to our client base, but the fact that those conversations are now happening means that people are actually taking this space seriously, and it's probably Generation Z that have done it. The old hands that used to trade all the time are like, oh, no, this is a silly space, no way. But the younger generation who don't have pensions, they don't have anything, actually now look at it as a genuine means to manage their wealth or to make more wealth. And that's obviously created the momentum in numbers and then the momentum in AUM, and therefore the institutions have gone, okay, let's have another look at this space. So it's not quite there yet, but I think it's starting to turn, and people are now starting to take this space seriously.
I'm happy you mentioned Generation Z, because I wanted to ask you, Salim, first. What do you think millennials and this fantastic Generation Z, which actually is a big market segment lately, technology has helped them get involved much quicker than we did, like 30 years ago, 20, when most of us in the panel started. So we don't want to talk openly about our age, but we do seem a little bit older. So what are these products that really favor these guys? And,
when we talk about product, ultimately you mean asset classes, probably.
Yes, in between.
So we don't see a big difference to what millennials or, quote, older guys like you and me, people trade. We are an EU-centric CFD broker, so you will see the traditional mix of tons of equity indices, because that's how the population was groomed by originally futures exchanges in continental Europe, and then migrated to CFDs because the platforms were just easier, better to use. We see obviously whatever hot stock is in the news, call it Tesla, a bunch of EU shares are top of the list on a regular basis. And then it's probably whatever is newsworthy at the moment. So Twitter was obviously pretty hot a couple of months ago. So there we see a lot of engagement.
Everything that Elon touches is hot, right?
Yeah.
So we thank this guy.
For us, very little FX, commodities, crypto CFDs. So we're really more of a traditional EU-centric house, indices and equities on both sides.
I think the trading instruments, now we have cryptos, for example. If you look back, if you go a little bit more back, 20 years ago, we had knock-in options, knockout options, Asian look-back options, all those kind of things. Yeah. I think there'll be more more types of products coming in based on the need of that generation.
But these products are quite professional. No retail investor would understand a knockout or an accelerator or things like that, because that's like a structured product for a bank. So if someone would do it, they wouldn't trade like at ease, so much.
It depends. People never thought about that. They could think about, like, for example, 7 years ago, if somebody told you Bitcoin, you're like, where can I see it? How can I hold it, right? Today, you don't ask that. What I'm saying is, when people start behaving certain way, every product, whether it is financial or it is physical, it is dependent on demand and supply. So when demand and supply comes from masses together, the way we are evolving as as a species, as humanity, it's like this, and the way we are, our demands and our requirements are changing will define the future of the financial products. So it's I think things will change significantly, faster than what happened last 50 years.
Maybe to just add one point, what is popular, it's the app. So the firms that are using an app only or app first strategy, we feel are the ones benefiting from the new generation of traders. So again, it's not sitting down at home 6 p.m. trying to open up, figure out what the US market does. It's really swiping through a trade at 2 o'clock while you're in the office, in the toilet or in the coffee shop kind of thing, trying to get positioned for the market. So it's a lot more of a hunch, in our opinion, than a really granular, detailed, research-driven process.
So what were the most unexpected developments then in this last year? So we came out of COVID, rushing out through everything that we could possibly put our hands on, and then you got like a very quick pace in these markets. What do you think the unexpected development was like?
I guess maybe let's talk about eToro's valuation. That's the only one.
Oh, you're jealous, I think.
Sorry?
They're IPOing.
So clearly they've ridden the wave really well in terms of making the company super popular around the world. But then there's obviously the limit of growth, and probably valuations have gotten ahead of themselves in Q1 and Q2.
Are these unsustainable?
Sorry?
Are these unsustainable, the valuations you mentioned?
Are they unsustainable? We don't know, but then we need to look at what the public market for stockbroker and CFD brokers have done over the last year. So if a Robinhood can drop from $85 to $10, then probably an eToro's valuation dreams might not be achievable at that rate.
And Mike, what do you think from a point of view?
Yeah, I mean, we sort of everyone had lockdown, didn't they? And I think everyone thought, say it quietly, but the whole industry that we were in benefited hugely from lockdown because people were at home and they were just going, well, what do I do? Some people were still, fortunately, still being paid, so the money was building up. They couldn't buy from the shops, they couldn't go on holiday, so they were building up a pocket of wealth, and they were bored. So, almost everybody was out there that was slightly interested, and they were opening up a trading account, and then obviously that the knock-on benefit to us is obviously social systems became popular with brokers as well because that then became a gateway in that these people weren't professional traders but they wanted the system. So almost every broker over the last 2-3 years should have had exponential results. I think the other thing we're seeing certainly from our broker partners is that they're pushing really hard into jurisdictions we'd never even heard of. We've heard of, but we just never thought. One of our brokers, Ava, has set up an office in Mongolia, and there's a big community there of traders. So it's really, from Vietnam to Indonesia, the people are really going for it in these far-flung regions, and the traction there is enormous. And I think that's so it's Europe has always been a very wealthy hub with lots of assets and lots of wealth, but actually the real traction is happening in these far-flung regions, and they're doing really well. And that's if you get exposure to that, then that's you've had a good time.
Tajinder, the closing remark is on you. Sorry, come again? The closing remark is on you. We give a microphone to the.
Sure. Yeah. for me, the biggest surprise was we don't have any more masks in the audience. You know, but yeah, I think you know, with respect to sustainability, I mean, the COVID time, we've seen you know, the participation by retail investor has gone through the roof, and it's all about demand and supply. But at the end of the day, if you look at the PEs, which is the standard way of saying how much can I make money by being in something, across the world, not just 1, 2, or 3 companies, they have gone to a level which historically has not sustained. So, you know, but yeah, I think even then they did create a lot of education around you know, social trading in general, and it's benefiting the industry in, you know, at large.
All right. I think we've got less than 2 minutes left. If anyone from the audience would like to pose a question for the gents here, we can give you a microphone. Anyone? Yeah, there you are. Can we give a microphone to the gentleman there? We've already given them a hard time, so be nice to them.
Thank you, gents. I would like to ask, as a strategy, how do you think, you know, which is the best strategy that take, you know, what's the best strategy? Take the best factor. You know, what factors it take to make it the best strategy? From what you see.
Either here or here.
Yeah, so what people are focusing on now, certainly brokers want us to focus on, is strategies with low drawdowns. So that means low risk. So you know, the ones that are popular and that create a longevity in an account that is going to copy them is really what they're after, and they're asking us to filter by those as well. So obviously we have leaderboards across the system, but they're saying please show the ones with the trade not once a month, because that's obviously not what they want. Other than the volume, everything else is actually in line with the client. They want, you know, something with low risk but solid returns. And it's key is it's educating the user that consistent return. If you can, you know, do anything over 1 or 2% a month, which is extraordinary if you could do that, but if you could do that, that's really popular. And then it's just making sure that the people that are looking at those strategies understand that, you know, if someone does 50% in a month, that's just a very strange bit of activity. They probably went short something and left it there accidentally, but that is not something which is sustainable. Certainly if you're doing 5%, you know, regularly for 2 years, you should be hanging out with Warren Buffett, not trading on a social system. So it's really making sure, yeah, the lower the risk, the better. Good volumes, so good trade volumes is what brokers like. And then, yeah, just, you know, the best returns you can get, and preferably not negative returns. That's kind of what is popular.
What's the best leverage for a good strategy?
So, yeah, I mean, a lot of strategies come to us saying, well, you know, it only works on 500 to 1, and you know, and we have lots of users that have 30 to 1 across Europe. So, when they do, we kind of slightly roll our eyes a bit, because, you know, I've got some school friends that work in very esteemed hedge funds in New York, and they trade on 2 to 1, and these guys are, you know, hedge fund managers, and they've been doing it for 20 years. So, you know, anyone that needs 500 to 1 to make something work is probably a little bit suspect, and it's very dangerous. But essentially, if they can make it work on 30 to 1, which is a sensible level, I think, in the UK and Europe, then that's okay.
I guess the time's up. You've been a fantastic audience. Let's give a round of applause for these esteemed gents. Thank you very much. And hope we got some information out of it, right?